Steve, are you with us?
I'm right here, John. How are you? Good morning.
Good, good. Nice to have you. How was your weekend?
Beautiful weekend here in Chicago. Nice and breezy, balmy 92 degrees here yesterday. It was
Wow,
Father's Day, so it was beautiful.
great. Some people don't realize how, a lot, maybe you do because you live there, but, that lake, sometimes it really gets to almost be Bahama-ish style blue right there
Oh,
outside of
yes.
Grant Park right there. It's unbelievable the color sometimes there.
Yes. I mean, as you might not recall, we have days where the humidity gets up to 100%.
Hmm.
So it's like living in the jungle for all intent and purposes, Caribbean islands. So,
Right.
I mean,
Yeah,
I,
that
I like it, so all right. It takes a little bit of time to get used to it, but once you're used to it, it's not a bad thing at all.
Chicago is a great city, man. It just totally
I
opened
agree.
my eyes to that city when I was there. I always thought cold Chicago Bears, things like that. It's actually just it's got everything for so many folks there. Um, I like it better than New York, but New York's cool too.
Well,
Um,
yeah, I used to live in New York, so I like both cities too.
cool. Well, listen, we're going to kind of do some things on the British pound, Brexit, footsie, and all the other things that get affected by some of the news events going on with the Great Britain leaving the EU. So, if you'd like to kind of speak your mind for a little bit and open up the show about that, that'd be awesome.
Sure. I mean, I kind of assume that most viewers know what the Brexit stands for. It basically means British exit of the European Union.
Hmm.
And it's kind of interesting to go back to get a better feeling for why it is actually happening. And you really have to go back before 2013. And there has been a political party in the United Kingdom called the UK Independence Party, or UKIP as it is short named. The party is run by a guy named Nigel Farage. And interestingly, I actually know Nigel fairly well. We go back almost 20 years now. He used to run a division for Refco, among other people, at the London Metal Exchange.
Wow.
And he is basically a financial services guy. So he's very much in tune with financial markets. He's very much in tune with how the world looks at certain events. And he's not a guy who is economically extremist on any issue because he has really made his money in the financial markets. But Nigel is also a very British person, if that makes sense. He likes his Sunday morning beer in the pub. He likes his fox hunting. He is very much the. I mean, that is what Britain is all about, John, right? I mean, for a lot of
Yes.
Britons, they are Europeans, but first and foremost, they are members of the British Empire. Britain is still a monarchy. People like their queen. And one of the reasons why that whole Brexit thing came up is because that British lifestyle, if you want to call it this way, has been under attack. At least that's how it's being felt or experienced by a few people ever since. So what
Right.
happened back in 2013, and that is really the day which kicked off the whole sequence of events we are staring down now, is that the UK Independence Party, which really was very much like, let's call it a fringe party. It wasn't
Hmm.
really a mainstream party. They had some seats in the European government, but really no representation in local governments. The UK Independence Party, out of nowhere, managed to get about 22% of the votes during the 2013 local government elections in the UK, which is the equivalent to our midterms.
Hmm.
So, out of nowhere, that new political party came out. Nobody had them in the cards. And just to put in perspective, the other two established parties only had like 24 and 28, 29%. So UKIP with 22% was right there. So that put everybody on alert, and all of a sudden, the whole idea of being anti-European became much more mainstream, and the established political parties certainly took notice. So then the 2014 European Parliament elections rolled around, and they had really high turnout. Turnout at the time was 35%, and UKIP actually won that election, which was a shell shock to everyone.
Steve, we're going to go to break. Can you hold that thought? We'll be back with you in just a second. Okay, thanks, guys. We'll be right back.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. John takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi guys, welcome back to the show. We've got Steve Benger luckily on with us today. It's just awesome to have you, Steve.
Thank you, John.
You're welcome. Hey, I'm showing the scanner real quick. This is the FTSE. The beautiful thing about the scanner, as you know, Steve, we talk about this all the time, is you can find anomalies going on. You can still find some stocks that just didn't want to cooperate here with the big move up in the FTSE. And those are the ones you probably should keep on the radar screen, at least block out from the long side. There's some up here that might be some decent. I think, well, we're going to talk about this at length today, but the markets could continue to move up. And some of these stocks that aren't really cooperating or raising their hands might be some stocks to look at. In case we're wrong, the market comes back down, might be some easy plays here. So just wanted to point out that you can get everything on the globe now, pretty much every major index in the world. We just added the ASX 200 in the Philippines in here, so you can find some things acting like you want to see them act. All right. I've said enough here, Steve. Let's continue. So you were given a little bit of history about the British situation, and if you could continue, that'd be great.
I think it's kind of important to understand why it's actually happening. So as I was saying before, UKIP came out of nowhere, and then the 2015 general election rolled around, and David Cameron, who is now the Prime Minister of the UK, basically crafted an election ploy in which he said, "Dear electorate, if you vote for me, I promise we're going to have a referendum over whether or not Britain should remain a member of the European Union." And that is why that is all happening today, because he wanted to get elected, and he felt UKIP coming up on his back, and in order to get UKIP off, he decided to kind of like put that out there to give people an excuse to vote for him. And it worked. I mean, he became the Prime Minister, but now he has to face down the consequences. And for all intents and purposes, it might be one of the worst peace political mistakes ever having been done in the United Kingdom. That's how some people feel about it, me included, quite honestly.
Well, you used to live in London.
Correct.
Like back, I don't know what years those were. We never talked about specifically,
late 80s, early 90s, yes.
Okay. And we've talked about this, how cool London is. I mean, I'd actually love to operate out of there for a while. It's just nice. I mean, in my opinion, my experience it was a great place. But, you got a chance. I mean, I've kind of been flashing in and out, but you actually had a chance to have a beachhead there for a while. Do you think that, like, obviously, what is it, 50-50 right now?
Yes. So there is actually a website maintained by the Financial Times, which aggregates all of the polling data available. And right now, as of this morning, the actual Financial Times poller is completely split, evenly split, 44%, with 12% undecided.
Right. Well, what's the rally that's happened was basically kind of getting back to par, and the girl that I forgot her name now, the woman who was in Parliament who got murdered by so-called the guy screaming Britain number one or at the same time. How much do you think that's affected it, and do you think we're going to have any follow through and get above par as far as the momentum of staying in the EU? And ultimately, what do you think is the ramifications of not staying in?
Well, that's a lot to cover, right? In a 1 minute response.
Well, we got the rest. We got 30 minutes left, so let's get into that, because that's what people I think want to know. Because what are the trading opportunities either way? So that's kind of where I'm headed. But go ahead.
So, I mean, let's talk about the stock market for a moment, because I kind of feel that is perhaps the easiest one to deal with. So the stock market, and actually let me quickly put it up here from my side if you don't mind, so give me a moment here.
Okay.
So the FTSE is right now in mid-range for the year. It's about 6,000 points right now. It was down early in the year, down to 5,500, and has been up to about 6,400. So for all intent and purposes, the market is very much like in the mid-range of the year, certainly not falling apart. It was a little bit weaker last week, but till then it actually held fairly steady.
I've got a picture of the continuous FTSE contract, so go ahead. I'm just showing it while you're talking.
Yeah, I'm looking at the cash index, so perhaps the numbers are a little bit off.
Yeah, it's about the same. About the same.
All right. Okay.
You're right. Okay, go ahead. Sorry.
So the FTSE is very much in the mid-range for the year. The FTSE is actually also done better by comparison than the Euro Stoxx index. So British stocks in general, despite all of that leaving nonsense going on, have done comparatively better for the year than a broad-based basket of European stocks. And I kind of think it means something. So what I believe to be the truth is that, generally speaking, the market is not super worried about Britain truly leaving the UK. And there are only two reasons why they're not really worried about it. The first reason is because they don't believe it's going to happen anyhow. And the second reason is that quite a few people seem to think that even if they were to leave the market, it's not that big of an event in the immediate future.
And let let me make a footnote to what you just said. Even if that somehow comes true, that vote eclipses, where they're, hey, we're going to leave. Isn't there about a 2-year process of transition involved before that actually happens? And would there probably not be another vote in the middle of probably some economic calamity going on and possibly change it anyway? Or
yes.
What do you? Okay.
So the procedure is, first of all, that vote is strictly what they call an advisory vote. It does not trigger a binding political process. But obviously, any government, I believe, has to abide by the will of the people, and that is kind of the reason why they're calling that referendum in the first place. But if they were to accept the referendum and call for an exit, they have to submit a formal notice to the European Union to exit the European Union, and that note carries a 2-year termination deadline.
Okay. So the market, seemingly, from what you just said, obviously has a bid in it, even though there's been some, especially with the equity side, even though there's been all these things spinning around. What would be, the U.S. market seemingly just wants any type of good news and it's going to rally, any hint of good news. Do you think the FTSE actually could break out above 6,300 ultimately here in the next, I don't know, week or two or month? And, do you think the U.S. market is therefore, or how do you think the markets in general are going to act? And what's the play possibly? We got about 30 seconds for break, by the way, on some of the equities markets, or where's the biggest bang for your buck if you're going to look at this and somehow try to squeeze some juice out of it?
I think the biggest bang for the buck, which might also be the riskiest bet for your buck, is actually the FTSE, British stocks.
Gotcha. Can you hang on and we'll continue right after the break?
Sure.
Thanks, Steve. We'll be right back, guys.
All right.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit tfnn.com.
Today, many commodities are trading at relative lows. And now you can take advantage with Everbank's new limited time, 5-year, market-safe currency comeback CD. This indexed and U.S. dollar-denominated CD offers 100% principal protection and is based on the equally weighted performance of currencies of Australia, Canada, Chile, Mexico, and South Africa. These 5 countries are especially rich in commodities, and their respective currencies are poised to do well should commodity prices begin to recover. Keep in mind that no APY, or periodic rate of interest, is paid on the CD. Don't miss out on this innovative new financial opportunity. CDs must be opened and funded by the upcoming July 14th deadline. To apply online and learn more about the CD, including product terms and disclosures, visit everbank.com/TFNN now. This advertisement is sponsored content. Everbank is a member FDIC.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, guys. Welcome back to the show. We've got Steve Benger on today, and we're talking about the Brexit situation, some of the ramifications of, the thing happening or not happening. And I think there's a kind of a buy support kind of feeling out there, I guess, between you and I, Steve, right now, all things considered. So if you could kind of continue, we were talking about what might be the trading opportunities around this type of scenario, and you were saying it, it's got some risk attached to it, but what are your thoughts on some of the ops out there?
So, you asked me during the last segment what is the biggest bang for the buck, and what I replied was that the British, the FTSE, British stocks, do offer the biggest bang for the buck, and I believe that to be true. I mean, last week the FTSE dropped about 6%. So the 6% decline in the FTSE has not been reversed. So if we were just to get back to last week's opening price, we still have another 5% to go in the FTSE. So clearly that offers the biggest bang for the buck. I don't necessarily think it's perhaps the smartest play, but in terms like if you really want to go for it, I think you want to buy a couple of options on the FTSE. That would really be the all or nothing play, I believe.
Do you think it's just flat out go along the calls, or maybe is there some way to kind of complicate it a little more than that, and be able to play defense against being just long the calls, or what are your thoughts on that?
Well, in reality, I mean, like one way to play it would be to sell calls expiring this Friday, which are a little bit out of the money, and then have calls long the following week. And the strategy behind it is that the referendum is on Friday, and the polls are not going to close before the option expires. So presumably, either way, the market is not going to make a big move till Friday. So hopefully, the expiring options expiring this Friday will pay for the long options for next week. So that gives you a way to get into the market on a much cheaper basis, and hopefully make more money. So that would be one way to do it.
So 6,300 right now seemingly is the unfair highs on the FTSE, on the long-term weekly. Do you think? I mean, let's just say we start leaning more towards above par on. We're not going to leave the EU situation. How far do you think this thing could go just from a relief standpoint? Not that it makes any sense from a stock valuation, blah, 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 whatever, just from sentiment piling into this thing. Where do you think this thing actually could head before Friday?
So
do you have any thoughts on that?
Yeah. So the 200-day moving average is coming in at 6150 right now on the FTSE. Okay. So I think the 200-day moving average is certainly possible. And then if the referendum provides the all green, meaning Britain stays within the European Union, I think 6,400, 6,300, somewhere in between, is certainly very doable within the next week, 10 days.
Okay, so that being said, as I go back into the S&Ps, and at the same time, I'm just going to reference some notes really quick here. Let me go up to these. So the 10-year, it's going off just a smidge here. by the way, the 10-year September contract is right now down into that 131, 12, 13. So we're kind of at a little bit of a support area on the 10-year right now, and that's what that yellow peel back on the charts means. We got to either wait to buy breakouts again or wait to buy support. You got really big support, 131, 07, 08, 131, 12. The U.S. stock market is up, 27 points this morning on the S&Ps? Is that, 27. So do you, okay, so right now, Steve, I'm showing on the charts, on the profiles, we've got support at 2082, 2083. And then we've got a new weekly profile, which people were talking about last week, and we've edged higher. So the new weekly unfair high is 2101 on the S&Ps. Do you think we're just going to have a relief, blow through the the all-time highs here, and just might not look back for a while, and all the shorts? What are your? Yeah.
So here's what I think.
Yes.
So we had a major volatility spike last week. It was actually one of the biggest volatility moves in actual percentage change we have had in the past 7-8 years. Okay. So despite that major volatility change in the market only pulled back about, let's say, 2%, give or take it. Perhaps even a little bit more, but let's say 2%. And that outsized volatility gain, which still hasn't reversed itself, I believe offers the market to almost have a springboard to lever off into higher grounds. So, and part of it we see this morning already, where the market just is going to open up 1% without really any particular reason for it. So I think the S&P completely will blow through the old highs, bearing an exit vote in the European Union now. I hate to say that because I would like to see stocks lower, but the way the market has been behaving over the past couple of days, I think it's going to go higher.
Well, that being said, is it what's the option play on this thing? Because we're kind of already kind of edging up into all-time highs. Is it something that a debit spread's in order here on the long side, or is it something to just kind of sell a credit spread down below, or some kind of calendar play, or that kind of? Go ahead.
Well, I mean, once again, you have this major event happening on Friday, which is going to decide short-term stock movement one way or the other. So you can actually play off it a little bit, and going back to the FTSE, one way to play that would be to buy calls on the FTSE and sell calls on the S&P, because any movement
now you're talking.
Yeah, but any movement in the FTSE will by far outweigh or will be outsized vis-a-vis move in the S&P. So the S&P, the selling of S&P calls might pay for the entire long call portion of your FTSE stocks, and because the call move on the FTSEs will be greater than the call moves on the S&Ps, that is how you're going to make your money.
I love it. I love that trade. The one you just stated right then. I love it. What do you think, as far as, the Euro stocks, 50, some of the DAX, have you gazed around? And I can pull up the DAX right now. Go ahead.
Well, the thing is that you can certainly look at them, but my point or my view is that you really want to stick to the actual theater of operations, right? Why trade a derivative of it? You really want to stick to the FTSE if you want to play that event.
Well, Steve, we're going to another break. Can you hang out for one more?
Okay, great. Perfect.
Right.
See you in a
Thank you.
Okay, bye-bye.
Has the current market volatility continued to stop you out of trades when the market spikes against you?
Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Hi, guys. Welcome back to the show. We still got Steve Benger on with us from Chicago. And Steve, I wanted to kind of run through a couple of usual suspects here and kind of get your thoughts on some of these, especially how Brexit might affect all these. And you had thrown out there earlier today when we were talking something about the UK bonds, the gilts, and how that may be intertwined with some of the things going on with. Okay, could you expound on that a little bit?
It's not necessarily a mainstream market to follow when you sit in the US, but the UK gilt market is the UK equivalent to our treasury bond market. And one of the consequences of UK exit would be a rise in funding costs for the European Union. So there's some sensitivity towards that whole quagmire. And the interesting thing about the UK gilt market is that the market actually made new highs for the year just recently, which means that their funding costs are actually lower than they should be, at least at first glance. So a lot of people
there's not a lot of scare in that market then, relative.
No, not at all. And a lot of people think that the UK or the interest markets in general are a little bit smarter than the equity markets.
Yeah.
So if you want to cue off that would indicate also that it's not going to be as much of a financial disaster than people make or want you to believe it sometimes.
Right. Well, I'll tell you what, I've got gold up right now. Gold is kind of broken out again and come back now and started to look at this retest around 1286. You think it might be over for gold for a little while, or what's your thoughts on that?
Well, I mean, when I look at the gold chart right now, we have the expanding top area, right? We have the expanding top made in late February. We have another one which then was done early May, and now we have another one in early June. And it just doesn't break through convincingly. So I actually think it might now trade down again to the lower channel. So I'm not a big gold fan right now. I think the money is flowing into equities right now.
Right. Yeah, that's something to look at that relationship. Gold, we may have a little bit of a trade and bounce around 1286, but you got to kind of be a little bit more stop oriented on this from the long side right now. You got to give yourself a little bit of noise around these levels. Of course, we always talk about that, but we had a breakout back in, I don't have to tell you guys this, around April 25th, hung around here and then just completely caved in, closed below, into our profile, retested, and went back lower. So we, based on what Steve just said, and based on some of the fear factor kind of being the air let out of that a little bit, possibly right now, you got to keep your finger on the pulse for that situation. As far as the U.S. Treasuries, I just kind of flashed this before for a little bit. This has been a little bit easier trade in general. Trying to be long treasuries and buy sport on treasuries rather than try to figure out the temperament of the S&Ps on a weekly basis, and all the things that go into, factor into trying to trade that market. Do you think the 10-year still, just because of the global arbitrageable rate situation going on, do you think the 10-year still has a bid in it, or do you think, because the U.S. markets may rise finally, the 10-year may finally give up? What do you think about that?
So, when I look across the world, Japan has now solidly negative interest rates. German bonds have now solidly negative interest rates in their 10 years. A lot of other European markets have negative interest rates too. And one of the only truly liquid bond markets where you actually still have a yield, no matter how low it is the treasury market.
Right.
So money is going to flow into treasuries because it's one of the last remaining markets where you actually have a positive interest carry, and I don't see what's going to break that trend.
I agree.
We do have economic growth, but it's lackluster at best. Liquidity is still being generated by the central banks because monetary policy is very loose across the globe. And if you have money, where are you going to park it? I'm not talking about investing anymore, right? Where do you want to park the money? So you're either going to put it into high dividend paying stocks, hoping that the stock doesn't go down, or you put it into the treasury market, thinking that even if the stock market goes down, treasury is going to go up because it's going to serve as a safe haven investment.
I agree fully. Can we move into the yen for a second? The the most non-understandable market ever,
Sure.
the Japanese market, like you just stated before. I'm going to pull up the Japanese yen right now relative to the dollar. 8th straight month of announced today of economic decline, basically, in the yen not really becoming devalued here. What's your thoughts on the Japanese yen and what the shakeout might be here? Do you have any?
Yeah. Well, honestly, the Japanese economy and equity markets and bond markets are, to me, an enigma wrapped in a riddle.
I love that.
Yeah, it really is. It's a different mentality over there, right? It's such a domestic market that it's a little bit difficult to handicap from my end. The reason why the yen is stronger today, I believe, is because the International Monetary Fund has come up with some statements urging the Japanese to do more on the stimulus side, and presumably the pressure is building on them to do once again even more on the stimulus side than they've been doing in the past. Like they hadn't been doing enough yet. But that is the reason why there's a bit in the market again on Japan. It's not about the fundamentals. It's about the prospect of what the government and or the BOJ, the Japanese central bank, again are going to do to support the market from here on out.
Yeah, unfortunately, we've kind of broken through that 105.5 area we talked about as support from before, and next stop down could literally be this 101.30 general area, which is, I remember when Steve, we weren't talking on a day-to-day basis like we are lately back then, but back in literally when I first started doing this show, the yen had kind of stayed in this channel forever. I mean, it was one of the longest long-term profiles I'd ever seen.
Yes.
And 101.33 was something we were lean on. I was like, okay, God, this is never going to happen. But when it happened, this is not going to be forgotten. So this 101.33 may have to be kind of retested ultimately. We got a nice bounce off 105.5 up into 110.40, but now we've kind of broken that. That might be used as resistance now, and then we may see 101.33 on the end. Yeah. But I hear what you're saying. I mean, it's an enigma wrapped in a riddle. If you'll allow me, I'd love to use that moving forward.
Oh, please.
Thank you.
It's all yours.
Thanks. Thanks. The euro. Do you think we got about 30 seconds here? Do you think the euro? What are you thinking on this one?
I mean, vis-a-vis the dollar, I think the euro is going to decline. Just because of the interest rate differentials, and we are a better place to park money right now. And there should be a short-term relief rally, though, when the when the Brexit vote turns out to be that Britain is going to stay in the euro. So there might be an opportunity to actually sell euros versus dollars late this week or early next week.
Well, thanks for coming on today, Steve, and we'll be back in a minute, folks. Okay.
Great. Perfect. Talk to you later, John. Bye-bye.